Listen, when a man sits in front of the tape long enough, he learns that the market is never in a hurry. Prices spend a lot more time sitting still than they do racing. That's why today we're talking about consolidation zones, those stretches on the chart where the stock just moves sideways as if it's half asleep. Now, you might remember in the previous video on how to focus on real signals, I told you that markets are full of noise. Well, consolidation is where that noise gathers and breeds. The real question is, are these zones our big friends or our big enemies? That's what I want to walk you through. You see, every trader is tempted by action. Our instincts crave movement, green bars shooting up or red bars plunging down. But the market, like life itself, doesn't always give us fireworks. Most of the time, it hands us long spells of nothing much, sideways drifts, narrow ranges. A stock will coil like a spring, bouncing between the same levels, testing your patience. Now, tell me, what do you do in those moments? Do you try to force a profit out of them, or do you wait? Because here's the truth. Consolidation zones can be the graveyard of an impatient trader. I've seen more men lose money in a tight range than in a roaring bull or a crashing bear. Why? Because they couldn't stand the waiting. They kept jumping in, buying breaks that weren't breaks, shorting dips that weren't dips. The stock just whipped them back and forth, chewing them to pieces. Have you ever felt that grind, where you take 3 trades and all you've got to show is a smaller account and a sore head? But don't mistake me. Consolidation isn't the enemy by nature. No, sir. It's just a test. It's the market asking, can you sit tight? Can you control yourself? And if you can, then consolidation becomes your best friend. Because out of those quiet zones come the biggest moves. The tighter the spring coils, the harder it snaps when it finally breaks. That's the law of the market. I've always said, the money is not in the buying or the selling, it's in the waiting. Consolidation proves whether you believe that. Think about it. A stock makes a big run, then it pauses. Do you think it's pausing for your benefit? No. It's catching its breath. It's letting the weak hands in and out. It's giving time for new sponsorship to step in. If you're sharp, you read those consolidations not as dead time, but as preparation. You watch the volume. You study the support and resistance. You note who's anxious and who's calm. You wait for the tape to show its hand. Now, I'll ask you, how many times have you looked back at a chart, slapped your forehead, and said, if only I'd held through that dull period, I'd have doubled my stake. I've done it. Every trader has. That's why I don't curse consolidations anymore. I respect them. They're where character is tested. The market isn't just weighing stocks, it's weighing you. Patience is a weapon. Don't forget that. In a range, the impatient give their money to the patient. The man who knows how to do nothing, absolutely nothing, often ends up with the lion's share. That doesn't mean we fall asleep, mind you. We don't ignore the tape. We study it even closer. We're like hunters in the brush, waiting for the slightest twitch. But we don't fire until the shot is clean. Tell me, are you the kind who waits, or the kind who itches until he shoots and scares the game away? You see, consolidation zones create traps. They lure in the novice who thinks every small uptick is a breakout. The market loves to punish that kind of haste. It will give you 3 false starts before the real move. That's why discipline is everything. You don't just trade because the stock twitched, you trade because the tape told you the real pressure is breaking. And how do you know the real from the false? You remember what I said in that other lesson? Focus on the genuine signals, not the noise. Consolidation is the greatest producer of false signals there is. But it also creates the stage where the true signal finally shines, if you can just hold your fire. Let me tell you something important. Wealth in the market doesn't come from chasing every wiggle. It comes from sitting on your hands through the wiggles and riding the real swings. Consolidation forces you to do just that. The average man hates boredom, but in trading, boredom is part of the work. You'll never build wealth if you can't live through the dull stretches. Can you stand watching a stock go nowhere for weeks while you do nothing? Most can't. They itch for action. They trade out of boredom, and they bleed their accounts dry. But the professional knows that the real money is made not in motion, but in position. Think about the mental game here. Every consolidation is a mirror held up to your discipline. It asks, do you trust your plan? Do you really believe in your setup? Or will you sabotage yourself just because the tape is slow? That's why consolidation is both your friend and your enemy. It's neutral, it's you who decides which it will be. Now, ask yourself this. Do you know what kind of trader you are in those zones? Are you the one who lets the market bully you into small, meaningless trades? Or are you the one who lets the market reveal its hand while you conserve your bullets? That answer determines more of your wealth than you might believe. When you sit in front of the tape long enough, you begin to see that price alone is never enough to tell the story. The chart may draw your eye with its little candles, climbing and falling, but behind every tick is pressure, the force of buyers against sellers, bulls against bears. That's why when a market goes into consolidation, when price moves sideways as though it has forgotten its direction, the careless trader thinks nothing is happening. He sees only stillness. But the careful trader, the man who knows how to read the tape with more than his eyes, understands that something very important is happening under the surface. He watches the volume, because volume in consolidation reveals the true pressure building, and it is this hidden pressure that often decides who will win the next big move. Think about it. A consolidation zone is simply a battleground. One side has just pushed price in a direction up in a rally, down in a decline, and now the other side fights back to stop it. The result is a stalemate, a sideways pattern. The average trader just sees boredom. But if you look closely at the transactions, at the number of shares traded each day, you begin to see which side is pressing harder. If volume dries up while price holds steady, it means the sellers are losing interest and the buyers are quietly soaking up stock. That's quiet accumulation, and it tells you the spring is coiling for an upward release. On the other hand, if every attempt to rise is met with heavy selling, and you see big volume on down days while up days are thin, then you know the stock is under distribution. The smart money is unloading while the crowd doesn't notice. Tell me, do you ever watch those shifts in volume when a stock looks lifeless on the surface? I can tell you from experience, the tape speaks more honestly in consolidations than anywhere else. In trending markets, everything looks strong because prices rise, or everything looks weak because prices fall. But in a range, price disguises itself. It acts as if nothing is happening. That's where volume becomes the interpreter. A breakout without volume is often nothing more than a trick, a false signal designed to whip out the impatient. But a breakout with heavy, convincing volume, now that's the real thing. It means the pressure that built up inside the consolidation has finally found release, and there are enough hands pushing in the same direction to carry it forward. Have you ever noticed how many traders buy the first breakout they see, only to be whipsawed right back into the range? It happens because they only watched price. They didn't ask, who's behind this move? How much stock is really changing hands? The tape punishes that blindness. Volume is the proof. When a stock has been trading sideways for weeks, it takes tremendous effort to push it out of its cage. That effort shows up in the numbers of shares. A quiet breakout is a fake breakout. A loud breakout is where you want to be. Let me give you a picture. Suppose a stock has been locked between 50 and 55 for a month. Every time it reaches 55, sellers appear and knock it back. Every time it falls to 50, buyers step in and hold the line. Now one day the price ticks 55.25, but the volume is lighter than usual. The crowd rushes in, thinking the breakout is here. But no real pressure supported the tick above the range. The stock falls back, and the crowd is left nursing losses. Contrast that with another day where price climbs past 55 and the volume is double its normal pace, with buying strong into the close. That is not noise, that is pressure being released, the true weight of demand showing its hand. The difference is night and day, and yet only the man watching volume will see it clearly. And here's another truth. Consolidation zones with steadily declining volume are far more powerful than those with rising volume. Why? Because declining volume means the sellers are exhausting themselves, interest is drying up, and supply is being absorbed by stronger hands. When volume shrinks to a whisper and then suddenly expands on a breakout, that is the purest sign of accumulation. But if volume steadily swells during the consolidation, it often means a tug of war is escalating, with both sides fighting harder and harder, leading to false moves and reversals. Do you see how volume is the clue to who is gaining the upper hand? Now, think about your own trades. How many times have you sat in front of a stock trapped in a range, feeling restless, wanting to act? You might have seen a green candle poke its head above resistance, and you lunged at it. But had you asked, where is the volume? Who is really behind this? You might have waited, saved your bullets, and avoided a whipsaw. Discipline in these moments separates the gambler from the operator. A gambler watches price and guesses. An operator studies price with volume and waits for confirmation. Which one do you want to be? The truth is, consolidation zones are deceptive on purpose. They are designed by the market to test your eyesight and your patience. Most traders fail both tests. They stare at the surface, chasing every flicker, while the professionals accumulate or distribute quietly in the shadows. Volume is the lantern you use to see in that darkness. It tells you when accumulation is happening, when distribution is taking place, when pressure is mounting for a break. Without it, you are blind. With it, you can position yourself before the real move, not after. Remember this: the market never gives money freely. It demands proof. And in consolidation, the proof is always in the volume. That's why I say volume in consolidation reveals the true pressure building. It shows you whether the spring is coiling for an advance or collapsing into a decline. It shows you whether the strong hands are quietly buying or quietly selling. It shows you whether the next move will be a friend or an enemy. And it does all this while price looks like it's asleep. Isn't that the market's greatest trick? To make you think nothing is happening while the biggest shift of all is underway. Now let me turn the question to you. The next time you find yourself staring at a stock stuck in a narrow range, what will you look for first? Will you judge by the surface of the candles, or will you look beneath them, into the heartbeat of the market, the volume? Because that choice determines whether you get caught in another false move, or whether you ride the genuine wave when it finally breaks free. And ask yourself further, are you patient enough to wait for that proof, or will you let your own need for action blind you to it? In every market there are two kinds of players, the restless and the disciplined. You can tell the difference when a stock drifts sideways, locked in a consolidation range. The restless trader cannot sit still. He pokes and prods, buying here, selling there, always trying to force a profit out of nothing. The disciplined trader does the opposite. He waits, he studies, and he saves his energy for when the market shows its real hand. That's why I say sideways markets transfer money from the restless to the disciplined. It happens every day, and most men don't even see it. Think about what a consolidation really is. A stock has run hard in one direction, then it pauses. It moves sideways, trading back and forth between two levels like a prisoner pacing in a cell. The price doesn't tell you much in that moment. It looks dull, boring, unworthy of attention. But here's where the trap is laid. Because the restless trader, who cannot stand inactivity, decides that he must do something. And in doing something, he gives his money away to the man who does nothing. Tell me honestly, how many times have you traded just to feel alive, only to regret it after the market whipped you back into line? Patience is not glamorous, but it is profitable. The sideways market rewards the man who holds his fire. Each time a restless trader buys a false breakout or sells a false breakdown, he pays a toll. That toll is collected by the disciplined trader, who sits quietly until the move is real, and then enters with size and confidence. The restless man has chipped away his own capital by the time the real move comes, while the disciplined man has preserved his ammunition. Which one do you think walks away with the lion's share of profit? Consider the psychology of the restless trader. He cannot endure uncertainty. When a stock is trapped between support and resistance, he feels an itch. He tells himself he sees a setup, when in reality he is inventing one. He buys because the price looks a little stronger today, or he sells because it looks a little weaker. But the market loves to toy with this type of thinking. It pushes the stock just far enough to draw him in, then reverses and spits him back out. The result? Small losses, again and again, until the account is drained not by one disaster, but by 100 tiny cuts. Isn't that the most painful way to lose? Death by inches instead of one clean blow. Now look at the disciplined trader in the same situation. He watches the same stock in the same range, but instead of chasing every twitch, he asks himself, who is winning this battle? He studies volume. He looks at how the stock reacts when it touches support and resistance. He notes whether the buyers are aggressive or the sellers are stronger. And then he does nothing. He keeps his powder dry. Because he knows the real opportunity is not in the chop, but in the breakout that follows. He knows the sideways market is not where money is made, but where it is transferred from those who must act to those who can wait. I've seen this play out countless times. I remember when a certain stock, no need for names, traded between 30 and 32 for weeks. Every day, it swung inside that narrow range, frustrating anyone who tried to scalp a profit. The restless traders piled in on every uptick, hoping to catch a run, only to be slapped back. They sold short on every downtick, thinking a breakdown was coming, only to be squeezed out. Meanwhile, the disciplined operators simply watched. They let the restless exhaust themselves. And when the stock finally broke through 32 with volume that could not be ignored, it ran straight to 38. Who made the money? Not the crowd who churned their accounts inside the range. It was the men who waited, the disciplined traders who struck only when the odds were in their favor. The market has a way of exposing character. In trending times, everyone looks smart. A rising tide lifts all boats, and the careless can ride along. But in consolidation, the mask comes off. The restless are revealed for what they are: gamblers, anxious for action. The disciplined are revealed as professionals, content to wait for the high probability moment. The transfer of wealth happens silently, one false trade at a time. By the time the real move comes, the restless are battered and broke, while the disciplined are fresh and ready. And let's talk about boredom. Because boredom is the real enemy in a sideways market. The restless man trades not because he sees opportunity, but because he cannot tolerate the feeling of sitting still. He mistakes boredom for risk. But boredom is not risk. Boredom is a signal that nothing worth acting on has appeared yet. If you can endure it, if you can let the market bore you without forcing trades, you are already ahead of the majority. Ask yourself, when the market bores you, do you seek excitement? Or do you let the boredom work in your favor? Wealth in trading comes not from constant action, but from selective action. The disciplined trader knows this. He treats his capital like a soldier treats ammunition too valuable to waste on random shots. The restless trader wastes his bullets firing into the dark, and when the real enemy shows up, he has nothing left. That is how money moves in the market. It doesn't just vanish. It moves from the pockets of the restless into the accounts of the disciplined. The market is ruthless, but it is fair in that sense. It rewards those who can control themselves and punishes those who can't. Every sideways range is a test of temperament. Do you need action so badly that you will sacrifice capital just to feel involved? Or can you stand aside, watching, preparing, waiting until the odds tilt in your favor? That decision is not about charts or indicators, it's about you. The market is always asking the same question: who will be the restless? And who will be the disciplined? And with every tick inside a consolidation, money is changing hands based on that answer. A trader can learn every chart pattern in the book, memorize every technical term, and still fail if he cannot master one thing: patience. Consolidation zones make this plain as day. When the market moves sideways, locked in a tight band, it's not testing your knowledge of moving averages or Fibonacci levels. It's testing whether you can sit still. That's why I say consolidation zones test patience more than skill. They separate those who must always be in the game from those who understand that waiting is part of the game. Think about how a stock behaves after a big move. It surges upward, gathering attention, pulling in eager money. Then it stalls. The price no longer climbs or falls in great strides. Instead it drifts, caught between a ceiling above and a floor below. This is when most traders get uneasy. The excitement of the trend is gone, the thrill of movement has died down, and all that remains is stillness. That stillness gnaws at the restless man. He thinks, I must do something, or I'll miss out. And so he trades in the chop, wasting bullets in a battlefield where no war is happening. Ask yourself, how many times have you thrown away money just because the market was dull? The truth is, the consolidation is not against you. It is simply the market resting. Like a prize fighter between rounds, the stock gathers its breath, shakes out weak hands, and prepares for the next punch. But the fighter who rushes in during the pause, swinging wildly, tires himself before the bell rings. The patient trader knows this. He respects the pause. He waits for the bell. Skill may tell you what the support and resistance levels are, but patience is what keeps you from acting until the signal is true. I've seen traders who could draw beautiful charts, who could tell you the exact mechanics of accumulation and distribution, who knew more jargon than a room full of analysts, but they still lost money. Why? Because when the market went quiet, they couldn't stay quiet with it. They bought every uptick and sold every downtick, trying to force trades out of thin air. Their skills became useless without patience to apply them. Contrast that with the old operators I learned from men who sometimes sat idle for weeks, doing nothing, studying quietly, saving their ammunition. When the market finally broke out of its cage, they struck with conviction, while the restless men had already wasted themselves into exhaustion. Which side do you think ended the campaign richer? Patience in consolidation is not passive. It is an active discipline. You are watching every tick, studying the volume, noting who is buying and who is selling. But you're not pulling the trigger until the picture is clear. That restraint is harder than any technical calculation. It's not the skill of the hand, it's the strength of the mind. A man can learn chart patterns in a week, but it might take him years to learn how to do nothing when nothing should be done. Tell me, have you truly learned how to wait, or do you just pretend to? Here's the irony. In trading, the hardest work often looks like no work at all. The man who sits on his hands through consolidation is working harder than the man who takes 5 trades a day, because he's fighting his own impulses, resisting the urge to grab at scraps, keeping his capital safe for the feast. It takes more control to stay out of a bad trade than to jump into one. That is why consolidation is such a brutal teacher. It doesn't test your chart reading ability. It tests whether you can control yourself, and most can't. Think about wealth building for a moment. The big fortunes in the market aren't made by constant nibbling. They're made by catching the major swings, the real moves that carry a stock miles from where it started. To capture those swings, you must sit through the consolidations that precede them. Every great trend pauses, rests, coils before it breaks again. If you lack patience, you'll sell too soon or buy too soon, and miss the very move that creates wealth. Skill might help you spot the setup, but patience ensures you actually benefit from it. I remember watching a stock hover in a tight range for nearly 2 months after a sharp rally. Many traders gave up on it, calling it dead money. They wanted action, not stagnation. They rotated their capital elsewhere, chasing smaller moves. I sat with it, doing nothing. My skill told me it was being accumulated, but it was patience that kept me from second-guessing myself. Then one day the breakout came, explosive, undeniable. The stock doubled in a matter of weeks. The men who left early never saw that profit. They were too busy trying to make pennies in other places. It wasn't skill that gave me the gain, it was patience to wait for the reward. And here's something important: the market knows human nature. It knows traders hate boredom, so it uses boredom as a weapon. Consolidation is that weapon. The market drags sideways long enough to shake out the weak hands, to frustrate the impatient, to lure them into false trades. Then, when the patient few remain, it rewards them with the move. That's why consolidations exist. They aren't just pauses in price, they're tests of temperament. Who will endure and who will give up? That's the real game being played. So ask yourself this in your trading: do you value patience as highly as skill? When the market gives you nothing, can you give it nothing in return? Or do you force a trade just to feel alive? Because if you can't sit through consolidation, if you can't let the market bore you without reacting, then no amount of skill will save you. The sideways market is the great equalizer. It proves who is ready to play the long game and who is just gambling for short-term thrills. And in that proving ground, money flows quietly from the restless to the patient, from the skilled without discipline to the disciplined without ego. Consolidation is a neutral phase of the market. It isn't good or bad, it isn't for you or against you, it simply exists. A stock moves into a sideways pattern, boxed in between support and resistance, and that phase has no bias. It's just a pause. But the trader who looks at it through his own emotions gives it meaning. If he is disciplined, he sees a friend and ally that helps him prepare, that tells him the market is gathering strength before a breakout. If he is restless, he sees an enemy, something that robs him of action, that frustrates him, that tricks him into false trades. That's why I say consolidation is neutral. It's your mindset that makes it friend or enemy. Think about it carefully. A stock that has been climbing can't run forever without resting. At some point, supply and demand balance out, and the price goes sideways. That sideways action is not a punishment, it's just the market catching its breath. But the impatient trader interprets it differently. He feels the market is against him, holding back his profits, wasting his time. He starts to think of consolidation as the enemy. Because his mindset demands constant movement, he sees stillness as an obstacle. But the seasoned operator understands that the market is not doing anything to him, it is simply doing what markets do. His mindset allows him to see the sideways phase as an ally, giving him time to position, time to read the tape, time to let the weaker players reveal themselves. Which way do you see it when a chart stalls? Do you curse it? Or do you study it? The truth is, the same chart can produce opposite results for two different traders. One will lose money in the range, the other will make money when the breakout finally comes. The chart didn't change. The price bars didn't change. What changed was how each man approached it. The losing trader tried to force profits from a dead zone. The winning trader let the market play itself out until the true move began. The difference was not skill, but mindset. One made the consolidation an enemy, the other made it a friend. This is why trading is less about what the market does and more about what you do in response. When price goes sideways, you project your own psychology onto it. If you need action, you'll see an enemy that withholds it from you. If you value patience, you'll see a friend that prepares you for opportunity. The consolidation itself is indifferent, it doesn't care about you. It only mirrors what's already inside you. And isn't that the hardest lesson of all, that the market is simply reflecting your own strengths and weaknesses back at you? Consider an example. A trader watches a stock trade between 100 and 105 for weeks. Every time it touches 105, he buys, expecting a breakout, but the stock falls back. He curses the chart, saying it's manipulated, saying the market is against him. In his mind, consolidation is the villain. Another trader watches the same pattern, but instead of jumping in, he takes notes. He sees that each dip to 100 is met with stronger buying. He notices volume shrinking as the stock compresses, like a spring coiling. In his mind, consolidation is an ally, showing him that accumulation is happening. When the breakout finally comes above 105 with heavy volume, the first trader is too exhausted to take advantage. The second trader rides the move with conviction. Both saw the same pattern. Their mindsets made the difference. Wealth in the market is built on catching big moves, not small chops. But big moves rarely come without a period of consolidation beforehand. That means if you treat consolidation as your enemy, you'll never be ready for the move that builds wealth. You'll waste your energy, your capital, and your focus inside the range. You'll arrive at the real opportunity with nothing left to use. But if you treat consolidation as your friend, you'll conserve yourself. You'll understand that the pause is a setup, not a punishment. You'll be ready to strike when the coil finally unwinds. Do you see how mindset is the deciding factor here? It's the same in life outside the market. Some people see obstacles as enemies, others see them as opportunities to prepare. The obstacle itself is neutral. The meaning is created by the observer. Consolidation works the same way. It is the market's way of resting, resetting, and preparing for its next direction. The choice is yours. Do you resent it and bleed yourself against it, or do you respect it and wait for it to serve you? Most traders fail not because they can't read charts, but because they can't manage their reactions. When the market is slow, their mind becomes noisy. They interpret boredom as danger or stillness as unfairness. They feel betrayed by the tape. But the market owes them nothing. It doesn't promise excitement. It doesn't promise profit. It simply moves in phases: trend, pause, trend. The trader who expects constant motion will always see the pause as an enemy. The trader who accepts the rhythm of the market will see the pause as part of the dance. Here's a truth that separates professionals from amateurs. The best traders often make their biggest profits not during the consolidation itself, but because they survived it. They preserved their capital and their confidence, while others drained both. The amateur forgets this and thinks every moment must be profitable. He treats the pause as wasted time. But the professional knows that the pause is where discipline is sharpened. It's where weak hands lose patience and strong hands build positions.